we are covering the important distinction between surety bonds and fidelity bonds for your property and casualty exam. First, understand that a surety bond is a three-party contract. The parties are the principal, the obligee, and the surety. The principal is the one who needs the bond and promises to fulfill an obligation, like a contractor. The obligee is the party who requires the bond and is protected by it, like the project owner. The surety is the insurance company that guarantees the principal will perform. A surety bond is fundamentally a guarantee of performance. If the principal fails to perform their contractual duty, the surety will step in to ensure the obligee is compensated, up to the bond amount. For example, a contractor who is the principal is hired to build a new office building for a developer who is the obligee. The developer requires the contractor to get a performance bond from a surety company. If the contractor goes bankrupt and abandons the project, the surety is obligated to the developer to either find another contractor to finish the job or pay for the financial loss. A critical point for the exam is the concept of indemnity. Unlike traditional insurance, if the surety pays a claim, it has the right to seek full reimbursement from the principal. This is because the bond is a form of credit, and the principal is ultimately responsible for the obligation. The surety underwrites the principal, believing they have the character, capacity, and capital to fulfill the contract, so losses are not expected. Now let's contrast this with fidelity bonds. A fidelity bond is a form of insurance that protects a business from financial loss due to the dishonest acts of its employees. Think of it as employee dishonesty protection. While technically a type of surety bond, on the exam, it's often treated as a two-party contract between the business, the insured, and the insurance company, the surety. The primary beneficiary is the employer itself. For instance, a company purchases a fidelity bond to protect itself from employee theft. If an accounting clerk embezzles $50,000 from the company, the fidelity bond will cover the loss. The bond responds to intentional wrongful acts, not just mistakes or negligence. A common exam trap is confusing the parties and the direction of the guarantee. Remember that a surety bond protects the obligee from the principal's failure, while a fidelity bond protects the employer from its own employee's dishonesty. Another trap is the idea of reimbursement. With a surety bond, the principal must indemnify the surety. With a fidelity bond, which functions more like traditional insurance, the insurer pays the claim without seeking repayment from the insured business. Here's a simple way to remember the difference. Surety secures promises to others, while fidelity foils fraud from insiders. Surety bonds are about guaranteeing external performance, whereas fidelity bonds are about protecting against internal theft. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.